Joel Greenblatt, you shouldn't invest in stocks. Active versus passive investing. Hello, fellow investors and lifelong learners. Today, we're set to examine a provocative statement from one of the greatest investment minds of our era, Joel Greenblatt. You shouldn't invest in stocks. Now, you might be scratching your head and asking, did a renowned investor really just advocate against investing in stocks? Well, hold on to your hats, folks. The context is not as straightforward as it may seem, and the nuance in this statement is what we'll unravel today. In our exploration, we'll venture into the dichotomy of active and passive investing, casting a spotlight on the pros, cons, and the evolving landscape of these investment approaches. Greenblatt, a seasoned investor and the author of the acclaimed The Little Book That Beats the Market, is a prominent figure well worth our attention. So, come along for the ride as we traverse through the world of investing, going beyond the traditional paradigms and stepping into a realm where investing is more than just a transaction. It's a relationship that calls for understanding, patience, and strategic decision-making. Greenblatt posits that investing is not about tossing coins into the financial fountain and hoping for the best, but rather a calculated, deliberate process. In his view, successful investing necessitates adopting an active or passive approach based on an investor's knowledge, time, and resources. Let's dive deeper into this thought-provoking discussion. Active versus passive investing. 1. Understanding active investing. Active investing refers to a hands-on approach where the investor or fund manager makes specific investments with the goal of outperforming an investment benchmark index. It's about using your knowledge, strategy, and instincts to beat the market. Greenblatt, an active investor himself, made his fortunes by investing in companies he believed were undervalued. 2. Understanding passive investing. On the flip side, passive investing involves buying and holding a portfolio that mimics an index, such as the S&P 500. It's about riding the wave of the market, accepting average returns and mitigating risks associated with market timing. The appeal here is the minimal time commitment and lower costs involved. Index funds, the sweet spot of passive investing. Index funds, the poster child of passive investing, have been gaining popularity. By replicating the performance of a particular index, these funds offer a way to invest in a broad section of the market. This method not only provides a healthy dose of diversification but also ensures you're not left in the dust if the market soars while your active picks sputter. Despite his active investing background, Greenblatt has expressed a fondness for index funds, especially for individual investors without the time or expertise to analyze individual stocks. This leads us back to his seemingly controversial statement, you shouldn't invest in stocks. When Joel Greenblatt said this, he was implying that unless you're prepared to devote a significant amount of time and effort to pick and analyze individual stocks, you might be better off investing passively, via index funds. It's a classic active versus passive debate, but one that acknowledges the value in both approaches, depending on the individual's circumstance. The relationship between investors and stocks. Think of it like this: if you're courting someone, you don't just dive in based on surface-level attributes. You take the time to know them, understand their strengths and weaknesses, and see if they align with your long-term goals. It's an investment of time and emotions. Similarly, investing in individual stocks requires a profound understanding of the company, its financial health, its competitive landscape, and its potential for growth. It demands active commitment, a characteristic. Commitment, a characteristic inherent to successful relationships. By extension, you can see the active investment approach as a committed, long-term relationship, demanding time and emotional investment. On the other hand, if you're not prepared to put in that level of effort, you might be better off with passive investing or, as Greenblatt would put it, not investing in individual stocks. It's akin to attending a social event, not to find a lifelong partner, but to mingle, enjoy the atmosphere, and have a good time. You're part of the scene, but not deeply invested in any single interaction. That's the essence of passive investing. You're in the market, reaping the overall benefits, but without the emotional roller coaster ride associated with individual stock performance. As we venture further into this discussion, let's dive into Greenblatt's wisdom and glean some insights. 1. Embrace your capabilities. Greenblatt suggests investors acknowledge their capabilities and limitations. For instance, if you're interested in the market but can't dedicate ample time to study and select individual stocks, it might be wise to adopt a passive strategy, index funds. 2. Know your appetite for risk. Different investing strategies come with different risk profiles. Active investing can potentially yield higher returns, but it also involves higher risk and volatility. In contrast, passive investing typically provides steady, long-term growth with less volatility. Understanding your risk tolerance is crucial in deciding which path to take. 3. Stay informed and evolve. The financial world is dynamic. An investing approach that works now may not work in the future. Greenblatt stresses the importance of staying informed and evolving your strategy to meet changing market conditions. 4. Patience and discipline. Whether you're an active or passive investor, patience and discipline are key. Markets can be unpredictable in the short term, but historically, they've trended upwards over the long term. Staying patient during market fluctuations and maintaining investment discipline can contribute significantly to your success. Monkey business in investing. In a surprising turn of events, let's shift our focus to an unusual aspect of investing that is, believe it or not, inspired by monkeys. This may sound unusual, but I assure you, the story holds a unique investment insight worth considering. The story was initially popularized by Burton Malkiel, a professor at Princeton University, in his 1973 book, A Random Walk Down Wall Street. Malkiel posited that a bunch of monkeys randomly throwing darts at a stock listing could generate investment returns that match, or even surpass, those of experienced, educated fund managers. As outrageous as this claim might seem, subsequent studies provided surprising support to this theory. Rob Arnott, the CEO of Research Affiliates, put the monkey theory to the test. His firm's study found that randomly generated portfolios outperformed the largest 1,000 U.S. stock portfolios by market capitalization with a shocking success rate of 98%. So, what's behind this unlikely success? It's the randomness of the monkey's selections. By randomly picking 30 stocks from the largest 1,000 U.S. stocks, the simulated monkey portfolios were more likely to include smaller cap and value stocks. Despite being less well known, these smaller stocks have historically yielded higher returns over time, averaging 10.5% annually compared to the 8.6% of larger companies. Moreover, the monkey portfolios distributed their allocations evenly across all selected companies. This is in stark contrast to the large stock portfolios, which tend to heavily concentrate their investments, placing around 40% of their total allocation in the top 30 companies. This equal distribution approach results in a diversified portfolio that doesn't lean heavily towards larger companies, thereby capitalizing on the superior performance of smaller stocks. It's important to note, however, that these smaller cap stocks come with their own set of challenges. They can be more volatile, riskier, and might witness larger fluctuations. They also might not have the same level of liquidity as large cap stocks. So, while they have the potential for higher returns, they also require a higher tolerance for risk and market swings. What can we learn from this unexpected tale of monkeys and darts? It certainly doesn't mean that we should forego careful research and analysis and leave our investment decisions to random chance. Nor does it suggest that real monkeys should take over Wall Street. Instead, the intriguing monkey business underscores the value of smaller cap stocks and the importance of a well-distributed, diversified portfolio. It demonstrates that large funds often overlook smaller stocks due to their mandate or size, creating opportunities for smaller investors to outperform. So, there you have it. When Joel Greenblatt says, "You shouldn't invest in stocks," he's not dissuading you from participating in the market. He's encouraging you to recognize your circumstances and invest in a manner that suits you best. This could be through the diligent analysis and selection of individual stocks or by riding the market wave with index funds. Greenblatt's perspective illuminates the value of both active and passive investing, underscoring the need to tailor one's strategy based on individual resources, expertise, and risk tolerance. This balanced viewpoint underscores why Greenblatt remains a revered figure in the financial world. His wisdom serves as a reminder that there is no one-size-fits-all approach to investing. Like many other facets of life, investing calls for introspection, understanding, and a strategy that aligns with your personal goals and circumstances. In his book, The Little Book That Beats the Market, Greenblatt discusses his magic formula for investing, a formula that focuses on PE and ROIC. But even without using the formula verbatim, it can guide us in simplifying what to look at when investing, cheap stocks and good companies. And why is this concept important? Let me tell you a story. This one comes straight from Joel Greenblatt himself. Picture this: you're a young kid. You have a friend who buys a pack of gum for 25 cents every morning from a candy store. Each pack has 5 sticks, and since it's tough to get gum at school, your friend sells each stick for 25 cents. That's $1.25 for a pack that only cost him a quarter. Your friend is making $3 to $5 a day just selling gum at school. Now imagine that same friend, let's call him Jason, grows up and opens a gum store. Each store costs $400,000 to open, but each year, the store earns $200,000. That's a 50% return on capital, which is impressive. Now imagine another store. We'll call it Just Broccoli. It also costs $400,000 to open but only earns $10,000 a year, a mere 2.5% return on capital. What Greenblatt teaches in his book, and what we can learn from this story, is that we should be looking for companies that can combine the best of these two worlds: low price, like the gum, and high return on capital, like the gum store. Now, let's delve into the gross margin. You might be wondering what a barbecue has to do with this. Well, imagine a summer barbecue where, amidst the chatter and the sizzling of steaks on the grill, we stumble onto the topic of gross margin. This essential metric, often overlooked, is a key that unlocks a deeper understanding of a business's strength and profitability. Gross margin is simply the percentage of revenue a company keeps after deducting the cost of its goods or services. Picture this: you're selling lemonade for $1 a cup. The combined cost of water, lemons, sugar, and cups is 40 cents. You retain 60 cents from every cup sold, translating into a gross margin of 60%. But why does this matter? Well, in the highly competitive business world, a moat is crucial. This moat is what sets a company apart from its competition. It's what provides a business its competitive edge, its unfair advantage. And how do we ascertain the existence of a moat? Through gross margin analysis, of course. A stable or expanding gross margin indicates a company's ability to raise prices without losing customers, a testament to its competitive advantage. In contrast, a declining gross margin can suggest a myriad of issues, aggressive competition, for example. While other metrics like revenue and earnings per share often steal the limelight, gross margin provides a more comprehensive view of a business's state of affairs. So, when you're looking at a company's financials, don't just seek the cheapest stocks. Aim to find good companies. Use metrics like gross margin and ROIC to guide your search. Remember, formula Greenblatt mentions, although simple, offers a broader perspective on investing by focusing on two crucial factors: cheap stocks and good companies. Every bit of knowledge, every insight brings us a step closer to better investment decisions. Next week, we'll delve further into the concept of gross margin and discuss how to decipher its fluctuations. So, stick around for that, and as always, remember that the world of investing is a journey of financial discovery. That's it for today's episode of Investment Uncovered. Thank you so much for joining us, and we wish you success in your investments in all aspects of your life. Until next time. Remember, investing isn't just about making money. It's about making wise choices that mesh with your life, your goals, and your peace of mind. Whether you choose to be an active investor or a passive one, always invest with understanding, patience, and a clear view of your financial horizon. So there you have it. Peter Lynch's timeless investing wisdom, an approach that has served him well throughout his illustrious career, which saw him post some of the highest returns ever recorded by a mutual fund manager. But more than that, these are insights that can guide any investor, regardless of their level of experience or the size of their portfolio. It's easy to get caught up in the latest market fads, or to be swayed by pundits predicting doom or prosperity. But as Lynch's strategy emphasizes, often the best way to success is to rely on what you know and understand. By focusing on your personal knowledge and strengths, you can unearth investment opportunities that others might overlook. Moreover, Lynch underscores the importance of understanding the companies you invest in, a principle that aligns with Warren Buffett's advice to never invest in a business you cannot understand. This approach can keep you grounded in reality and help you make sound investment decisions based on a deep understanding of a company's fundamentals, rather than fleeting market trends or sentiment. Lynch also advises against speculation and short-term trading. This aligns with the broader tenets of value investing, which stress the importance of a long-term perspective. It's important to remember that investing isn't a get-rich-quick scheme. It requires patience, discipline, and a steadfast focus on a company's intrinsic value. In closing, while investing might seem daunting or complex, Lynch's strategy distills it down to its core essence. Investing is about understanding businesses, leveraging your unique knowledge, and making informed, patient decisions. Whether you're a seasoned investor or just starting, this is wisdom worth keeping in mind. Remember, there is no one-size-fits-all strategy in investing. Everyone has different goals, risk tolerance, and circumstances. What works for one investor might not work for another. The key is to develop a strategy that fits your unique needs and stick to it, no matter what the market is doing. Peter Lynch's approach provides a strong foundation for individual investors looking to build or enhance their investment strategy. With his guidance, you can harness your unique knowledge and insights, make informed decisions, and set yourself up for long-term success in the stock market. So take Lynch's advice to heart. Start to see the world around you as a treasure trove of potential investment opportunities. Look at the companies and industries you interact with daily. What do you understand better than most people? What knowledge can you leverage? You might just find your next great investment right under your nose. And if you ever feel discouraged or unsure, remember this advice from Peter Lynch: the person that turns over the most rocks wins the game. And that's always been my philosophy.